Hey guys, and welcome back to our YouTube channel, Shreveport Bossier Home Guides, where we talk all things real estate and move into this great area of Shreveport, Bossier, Northwest Louisiana. All right, so let's jump right in. First question that I get, that's the most common question is, hey Ryan, I'd love to look at a house. I want to see a property, but I don't know what to do about getting my loans done. I don't know about financing. I don't know where to go, who to talk to. And quite frankly, it sounds bigger than it is. In reality, most of you already have a bank account set up with some lender, some banking association like Bank of America, Capital One, whoever that might be. Any financial institution, for the most part, is going to provide at least the service of mortgages. So you could either contact your bank, credit union, financial institution that you use, that you're already a member of, and say, hey, I'd like to talk with someone within your mortgage department to talk about what are my options, what type of loans are out there, what are the interest rates, and what does it cost me to secure the loan or to borrow the money in order to purchase the property. So what that might look like is this. There are a number of loan products, and I call them loan products because that's really what the bank is selling you. They're selling you a product, and that you have to qualify for that product in order to utilize it. So for example, there are some loan products that you hear about, like let's take rural development as an example. Well, rural development loans are very common, if you will, because a lot of people look at that and say, well, I want to be out in the country and I would love to have a loan that doesn't require a down payment. Well, a rural development loan is one that's like that. However, you have to be within the certain map that would qualify for a rural development loan. That's one caveat of that one. And the second thing is there's income limits. So you may make too much money in order to utilize that loan product, but it just depends. So in those situations, I always tell people, contact your mortgage lender or your banker or your credit union and identify what type of loan products are out there. So we gave you an example there of a rural development loan. Now let's talk about what I see are the most common. There's three major ones that I see in kind of my practice. One is what they would consider conventional loans. Well, conventional loans are great. They're wonderful, but they do have a little bit higher down payment requirements. So for some people who wouldn't qualify for other types of loan products, remember what we're talking about, a conventional loan might be a very good option for you. And you would be looking probably somewhere in the neighborhood of a minimum of 5% down payment, up to maybe 20% or above, whichever, whatever you would like to put in. One of the reasons why people do want to try to put down this 20% number, right, the 20% down payment number, is that there is something called mortgage insurance that is required until there is enough equity within the property of 20%. So that is that monthly cost, if you will, is added onto your monthly payments. And so that can kind of drive your price up. So if you have 20% and you want to put it down, that's a great way to go about it. So conventional loan types are one that's a great loan product for most people would qualify for that. But definitely something you'd want to talk with your mortgage company or your banker or your credit union about, because they can help you see if that type is a good fit for you. Now, the next one I want to talk about is FHA loans. So these are federal housing loans that are backed by the federal government. And one reason that I see why most people like this particular loan type is it has a lower down payment requirement. It asks for 3.5% down. And of course you can put more, but that's the minimum. And so a lot of people utilize that loan type because it's a lower entry because things cost a lot of money these days. So that's one of the other ones that they would look at. Same, you still would have to qualify for those types of criteria, whichever there's FHA criteria are. And so you'd want to talk with your mortgage lender, credit union, bank about how do I get this? Is this an option for me? Do I qualify for something like that? So really you can kind of crunch the numbers between conventional, for example, FHA, for example, and then make a decision that best fits for you, your family, and your budget. Last one that I want to talk about as the third most common is VA home loans. Now, veteran affairs home loans are going to be a special caveat or carve out only for those service members or veterans that qualify for that particular loan product. Now, why that's a great loan product is because it requires 0% down. So it's a 100% backed loan and 0% that you have to put down. So that's a great option for you, especially if you can qualify for that. If you're an eligible service member or eligible veteran, I definitely encourage you to look into that and have a conversation with your mortgage broker, your lenders, your credit unions, your banks, just to kind of see, again, what the numbers are. What does it cost me? Because, again, all of these loan products are going to have a fee. There's going to be fees associated with securing those loan products. And it's very, very wise of you to try to shop those different rates, shop those different loan products, shop those different fees, then really kind of see, what does this cost me? What are the closing costs? What are the costs of getting or securing this mortgage loan product? Now, once you've established your budget and you've identified what that loan product you want to use is, that would be the time that you would reach out to us, ideally, and say, hey, Ryan, I got my financing stuff squared away, but I'd love for you to show me this house. I kind of already have a really good firm understanding of what my budget is, and I want to see some houses that are within this budget that fit for what I'm looking for. I need a 3-bedroom, 4-bedroom, 5-bedroom house. I want 1,700 acres. So whatever it is that you're looking for, we can then find you something. And your real estate agents would be able to find you something within that criteria, and you know that you can afford it. So those things are really important, and something that, when you first start out looking for houses, you may want to go look at all of them. Well, if you can't afford all of them, you may not want to do all of that. So check with your mortgage broker first, or your lender, your bank, or your credit union first, and then let's have a conversation to see what houses that we want to look at that might fit for your budget.
Loan types that I discourage, things that I think are probably less beneficial for a buyer to utilize than others. And those loan types would be adjustable rate mortgages. Now, people will say, why don't you like them? It's cheaper when I get in. So why don't you think I like them? What do you think it is? Well, you're right, because the interest rate adjusts. And I personally think that that's a detriment to the buyer, you, the borrower, the consumer, the person that's paying for that loan. Anytime those interest rates adjust upwards, it puts a significant strain on your finances. So personally, I think these are loans that I would discourage moving forward. So let's talk about what that looks like. If you remember back 2008, 2009, 2010, mortgage financial crisis, all of the banks were stressing, there were significant foreclosures, all of those things. And one of the biggest culprits for those were adjustable rate mortgages, 5-year ARMs, 10-year ARMs, 15-year ARMs, interest-only loans, all of these types of products that mortgage brokers were using to get consumers into a home. And when the adjusted rate changed, well, you're stuck with it. And so somehow we fast forward now into this market where interest rates are significantly higher than they were, say, last year and the year before, which has put a lot of pressure on buyers. From just a monthly income standpoint, they've been starting to float around these ARMs again, and I just think it's a bad idea. I think it's a terrible way to promote people in getting into a home when those swings of your income could be significantly changed. So what does that look like? Well, Ryan, hey, they've got these things, a 3-2-1 buy down. So what that would say is, if, for example, you bought a 30-year fixed mortgage, let's say at 8%, well, the first year of that 30-year mortgage would be adjusted down 3 points. So it would be a 5% mortgage for the first year. Second year would be a 6% mortgage. Third year would be a 7% mortgage. And then the fourth year, you would continue on the rest of your 30 years at the 8% rate. Sounds good in theory, sounds good in the short term of that first year, maybe that second year, but those 1 point swings could be pretty substantial monthly from a cost standpoint. And one of the things that people will say is, well, you can just refinance when the rates go down. Possibly, that may be true. It may also be the point where that may not be the case for you. Maybe, for example, that mortgage company that originally sold you that loan product has also then sold your loan to another company for servicing that loan. Well, who does the refinance now? It would or could potentially be that new company, or you would have to go find another company to refinance that loan. The other thing is, well, maybe certain situations for you have changed, like maybe you changed jobs. Maybe your income has slightly adjusted. Maybe you went to more of a commission-based structure for your income. And so all of those things for a refinance would have to still align in order for that bank or that lender or whoever to issue that new mortgage with a lower fixed rate. That's one of the reasons why I just feel like there could potentially be too many things that go wrong in your personal life that makes it very difficult for you to get that refinance. The other type that I've been seeing out there, we talked about the 3-2-1. Well, guess what? There's a 2-1 buy down. It's the exact same principle, except if you were at the 30-year fixed on an 8-year or an 8% rate, it would be 6% for the first year, 7% for the second year, and then 8% after that. And of course, the thought is, well, just refinance it. Just refinance it when the rates comes down. Of course, that's great in theory, but my concern for you as an individual and as a buyer, as a person who is trying to purchase a property for the most appropriate price for you, anytime you hear adjustable rate mortgages, for me, I think that's a big red flag and something that I would say, perhaps explore that in more detail. Make sure that it's the right fit for you before you do that. Don't just so much focus on, well, the first year, first month, I can afford it. If you're going to use that too as a loan type or a loan, product, and you're gonna say, hey, I want to do this 2-1 or 3-1, 3-2-1 buy down, get it to a place where you can at least still afford what the full amount would be. Now, my worry on that part is most people, maybe not you, but most people, if they're catching those, say, $300 a month savings on the front end, by the time they hit their full percentage at when that full percentage kicks in for their mortgage, they've probably already spent up what that savings was. And so now they've got a pretty substantial gap to fill. So those are some of the thoughts that I have on adjustable rate mortgages. There are other reasons or ways that people use adjustable rate mortgages. For example, commercial properties like investors. Oftentimes, banks will have them do a 5-year ARM on say, for example, a 15-year commercial term or mortgage. And every 5 years, of course, that rate is subject to change. And if it changes up, obviously that changes your cash flow from an investor's perspective. If it goes down, that's beautiful. That would be wonderful. You would increase your cash flow or your rate of return on whatever your investment was for that particular property. So adjustable rate mortgages, in my opinion, are something that you should probably avoid. If nothing else, you should definitely discuss it with your mortgage lender and really get an understanding of what it looks like today and what it's going to look like next year and the year after, or then when it goes to the full fix, so that you can make sure that you truly afford what you're getting. All right. Now, what I want to talk about, and one of the questions that I get often is, Ryan, what are my closing costs? What does that mean? So oftentimes working with a real estate agent, in hopes you're going to try to get the ability to have a seller provide a credit for some of your closing costs. Now let's talk about the term closing cost as a whole, because really it's a combination of a number of different fees or costs to you as the buyer, because it is a buyer cost of doing that transaction. So it's your money that's got to be paid in certain ways. Now, if we can get a seller to contribute some of your some money towards your closing costs, that's wonderful. That's definitely a benefit to the buyer. It's a cost to the seller, but only in terms of credit, and it's paid at closing to settle that transaction. But let's talk about what that is, because I hear it all the time. Man, what are closing costs? Well, let's see. In essence, if you think of it as a big, say, pie, for example, if you're going to use a lender, a mortgage lender, they're going to charge you fees to cover your loan, right? They're going to charge you fees in order to give you the money. Some of those fees are going to be paid as closing costs. So that is one section of your, say, pie of closing costs. Up here is lender fees, okay? That's one part. Now, there's also a title company involved in real estate transactions, and what title companies do is they basically assist in the transfer and transition from ownership of the previous person to ownership of you. And thus, because of recording fees and transfer fees and all of these different things, and also the attorney's fees, the title attorney's fees to do this, there's also a set amount of fees that will be paid as closing costs. So of your circle, your big circle, you have lender fees, and now you have title attorney fees. So let's talk about the other portions of closing costs. Now, what that's going to look like is you have, as a part of your mortgage payment, you're going to have what's called an escrow. Now, an escrow, as a definition, an escrow account is really like, think of it as like a piggy bank. It's a separate account that money's being distributed into or put into every month for you by your lender, so that your lender can pay for things like property taxes and insurances at the end of the year. So that the lender makes sure that your property taxes and your property insurance is always paid up. They really want that made sure that's paid up. So that escrow payment has to be what they call prepaid. So some lenders will require 3 months of prepaid insurance, property taxes into your escrow account so that there's money in there. Some of them want 6 months in there. Some of them want 12 months in there. So that portion of your closing costs, your prepaid portion of your closing costs, may vary quite a bit depending on what your lender requires. But that is what those monies go to. So they go to fund your escrow account as a head start, so that when you need it, the money is there for them to distribute out to those things. So property taxes and your homeowner's insurance. And if you have flood insurance that's required, that will also be part of your escrow account. So as a whole, as a big pie of what is closing cost, you have your mortgage lender fees, title attorney fees, prepaid property insurance, and prepaid taxes. So out of all of those, that's closing costs. And that may be anywhere around 2 to 3%, depending on what the purchase price is and what those monies come out to in terms of holding certain things or certain fees. So it's a little hard to kind of narrow that down specifically up front when you first do your contract, you first do your paperwork on the property that you're going to buy. But it's somewhere in, generally speaking, around that 2 to 3%. It's a really good idea. So as you think about, hey, Ryan, what are my costs to buy a property, right? We talk about, well, you have to have a down payment. Most people would have to have a down payment amount. And that amount can range anywhere from, say, 3.5% on up. It could be as high as you want it to be. So you have let's say, for example, you have a minimum 3.5% of your purchase price is a down payment. Then you have your closing costs, right? And we talked about that wheel of closing costs, your lender's fees, your title attorney fees, your prepaid property taxes, and prepaid insurance. That's a fee there. That's really what you're looking at in terms of what does it cost me. Now, there are ways, like we talked about earlier, where perhaps you can build in a credit from your seller that's selling you the property. They may be able to provide you some credit, some money towards your closing costs. Maybe your lender is providing a credit towards closing costs as like a promotional thing to secure your business or to secure your loan. So there's a lot of different things out there. And as a consumer, as a buyer, I want to make sure that you're protected as much as possible. It's important, in my opinion, to shop your mortgage rates and shop your mortgage fees. You can also shop your title attorneys and shop their fees. On par across the board, they're probably going to be relatively the same because it's competition. And if one is really, really high and one is really, really low, you know, there's going to be some market equilibrium there that has to be found. So there's usually a pretty good parity between all of these entities, but it's important to shop them.
One of the things that people don't really realize, though, is they'll ask me, well, isn't that going to impact my credit score? Well, here's the cool thing. The Consumer Financial Protective Bureau, the CFPB, was created after the mortgage crisis, 2008, 2009, not that time frame. They brought in a group of people who work for the government, and their goal is to protect consumers, you, the buyers. And one of the ways they protect you is providing you protections or coverage that allows you to do some things like shop your interest rates. Now, what does that look like? Well, if you have multiple inquiries, right, multiple attempts to shop your rate, hey, I'm shopping with Bank A, I'm shopping with Bank B, I'm shopping with Credit Union A, Credit Union B, and Mortgage Lender C, right? I'm shopping with all these different places. As long as you do that shopping or interest or that credit inquiry within a 45-day window, you'll only get charged one credit inquiry, one credit pull. So yes, having a credit inquiry does reduce or slightly impact your credit score, your overall credit score. But as long as you do all of these like type lending inquiries within the 45-day window, you should only have one pull. The way they look at it really is you're only going to buy one house. So yes, you shopped a bunch of rates. Yes, you did your homework to identify which has the best deal for you, but you only are going to really pull from one. Now, if you do those 5 different lending inquiries for one mortgage home, right? But then you go and you say, well, look, I really want to go to Haverty's or whatever furniture store, and I want to get my bedroom set, and I want to see what they have to offer there. Well, that's a different type of credit inquiry, and thus you would be dinged, if you will, for both inquiries, right? All of your mortgage inquiries or credit searches would be under one, and then here comes the other one, which is a completely separate deal. So hope that makes sense for you. Hope that helps, and I definitely want you to be shopping those rates. Find the best deal for you, and then give us a call so we can find you your perfect house. Thanks. Have a great day.